Welcome, everyone. It's Angelo Robles, founder at Family Office Association and host of the Angelo Robles podcast. Today, how about this title? How the top 0.001% invest. I want to learn too. And who's the special guest that will help us do that? That would be Salvatore Buscemi, CEO and founder of Dandrew Partners, LLC, and author of the book, Investing Legacy, How the Top 0.001% Invest. So now you know where I got my title from. How are you, Sal?
I am great. Thank you, Angelo. That was a very nice introduction. I appreciate it. Last time I saw you was in Greenwich 3 years ago on a very, very rainy Wednesday.
Yeah, so what Sal's talking about is back in the day prior to COVID, I used to host larger scale events around the world, and Greenwich is our backyard, and a mutual friend had a chance to introduce us, and it was great then and great to see you now. And we're still doing in-person events, actually probably more of them than ever before. They're just very intimate and small during kind of the COVID or a little bit of the COVID transition. But really excited to have you on. Now, given that title and what you wrote about, and given a little bit of my role and my interconnectivity in the community, I can relate to some of the things you're going to talk about, and I look forward in terms of sharing those ideas. Why don't I start with, so how these families create legacy wealth? It usually is going to come from first accumulating wealth. There's a wealth creator somewhere along the way, and I'm usually going to go on a big stretch here, Sal, and says that probably comes from building a business that grows and becomes very successful. Is it possible to build a kind of legacy that you're talking about by being a C-level executive in another company? Yes. Of course, you could also be an inheritor, but maybe talk a little bit about how wealth is created and then developing the legacy to have it be sustainable through generations.
Yeah, it's a very good question, and I appreciate that. I wrote the book, and even though I haven't sent you your copy autographed yet, I'll tell you, it's written as a handbook more for the emerging families. Angelo, you and I know a lot of established operating families, and these families have a policy and procedure of doing things, but the emerging families do not know what's going on, and there's been a vicious transfer of wealth that's happening in real time to the tune of $9 trillion, and there's no user's manual for it. And what's happening today is that you have oversimplistic, asymmetrical advice, usually from broker dealers, talking to families, saying they're a family office, but offering them something that really doesn't help them with their problems. And getting to your point is the wealth is created either by doing something different, right? Grandma and grandpa have their name on the side of a library because they did something different, whether they started a company or whether they were serial experienced entrepreneurs, people who have had multiple exits. There's a lot of wealth that we created many different ways in this country. Today, we use media as a lever, and we can talk about that a little later. But how that wealth today is expressed is something that people, I think, have a internal conflict with, because there's a lot of issues and emotions that go along with that, and most of which is your identity. And I think sometimes you see people that there's different families, and some of them don't want to toe the family line. And there's a lot of people who believe that if you become wealthy, you have to dress like Bill Gates or Warren Buffett, eat cheese, cherry cokes and fries and everything. But the real part of it is today, as I wrote it, to show people that not everybody looks like this, and you need to pick your own identity first before you can back into preserving the wealth, because some families are very conservative. They love real estate. They don't know anything other than real estate. But when the next generation comes on and they want to see some sort of a change, that's where you start to see the difference in personalities of how the legacy is going to be expressed over time. And that's where there's a lot of conflict that comes in. But for the newer emerging families, they don't have what I call an impact statement, which means how do they want to be thought of after death? How do they want the epitaph to read? And once they start getting into that, then it's a lot easier to choose and partner with other families who have the same in-kind reputation into assets that will help them continue their legacy, put a layer on their legacy, at least ensure a little bit of it. There's a lot of money out there, believe it or not, and a lot of people have absolutely no idea what's going on. And you'd be surprised at some of the stories I hear of some people, and they're just desperate, really.
I mean, I remember going back, I may have my timeline a little off, but about 25 years ago, reading a book that's one of the best-selling books of all time, Rich Dad, Poor Dad by Kawasaki. And he basically talks about the basic gist of the book was, work hard and put your assets and resources into things that are long-term and grow in value. And potentially, if you're able to get dividend and income plus appreciation, that's great. So he was very focused on real estate. You could also argue certain select stocks, private companies, and there's other assets and resources.
Of course, but remember, not all real estate is made equal, right? The middle class likes to speculate on single family homes to create wealth. There's, since that book was written, there's been a whole cable channel dedicated to get rich quick, many of them, right? First of it's the CNBC. The other one is the Home and Garden TV, flip this house, flip that house. So people today look at real estate not as an investment, as I think how I thought the principles of that book were expressed. And again, I read it very, very long time ago, and I have respect for the book, but I think he was thinking of that as something as not speculating and flipping in a low interest rate environment. It was actually acquiring houses and using that to create wealth and use that as a stepping stone to evolve, right? Because let's face it, nobody ever got rich owning hundreds of single family homes. My first credit fund, I had over 1,000 of those things, and they were awful to deal with because we had to buy a lot of these stress loans from Bear Stearns and other banks. So a lot of the families we talk about today, people think real estate, and they think, oh, real estate. And then they follow an article how Bill Gates is buying 10,000 acres of farmland somewhere. So they think,
yeah, we're going to get to farmland.
Yeah, but we're not. But again, Bill Gates is buying it at a different basis than the guy is online on a fractionalized real estate site that's selling pieces of farmland for, as little as $25 investment. You don't really know what it is.
Good points, good points. In terms of the big macro picture from your experience and your data sets with the 0.001%, and we'll get into the micro of things like real estate and private equity shortly and a deeper dive, but what are some of the big picture takeaways? And I know with you, the importance is going to be not just broadly macro, what they're thinking, how they're investing, but in terms of what they want their legacy to be.
Yeah, that's a good question. The first thing that comes to mind is that you're starting to see a bifurcation in class as it relates to the investments that they invest into. You're starting to see the lower middle class, the middle class, anyone under $1 million, they're just going into liquid stocks. They're speculating because that's a wealth creation mechanism for them. So their needs and wants are much different than anyone with $100 million net worth, or what we call 1,000th of the top 1% of families. And the top 1,000th of the 1% of those families want to leave an impact. And what they're investing in is not the Rolls Royces. It's not really anything like that. It's defining their legacy and branding it after death. You can think of any library in the world where this is done, but I'll tell you today, you're starting to see it. And I don't know if this is a good segue into sports investing, but you're starting to see a lot of sports players create a lot of media, and then themselves are creating a lot of influence themselves, leveraging the media to do that. So it's becoming something more and more apparent. But those people, because there's a lot of wealth there, people are looking, of course, to find the ways to invest and to define their legacy and their impact in a way that's accommodating to them. And a great example of this is Bill Gates. No matter how nefarious we think he is, we all know he's branded a certain way to do something. Same thing with Elon Musk, same way with Jeff Bezos.
Now, I know you're very active in the world of looking long-term, so possibly through generations of owning what some would call illiquid assets. We all grew up learning, right or wrong, that if I'm going to invest in illiquids, I hope to get probably 3%, 300 basis points above arguably what the S&P is getting. And I'm being very broad, I get it. But I am sacrificing liquidity. But I am also accruing wealth very strategically in private businesses and real estate. You mentioned sports teams and other assets. Could I make the point, though, that wasn't 2009 or 10, right after the financial crisis, a great time for illiquids? And is it a softer market now?
Yeah, no, I think what's happening today with the illiquids is that people are coming into it because they see it as private company arbitrage. So whatever you think it is, a sports team, LP interest in a fund, whatever you think it is, maybe it's anything that's going public, ventures, anything in the venture space or private equity, things that are not privately traded. A lot of the wealthy people are attracted to it because they are able to exert influence on the things that they would not be able to exert onto, say, for example, with a publicly traded stock. they're able to get in at these private companies and direct investments at a better basis than probably other people. There's a lot of control. They can pick and choose the people who are on, who are on the team. But when you look at the bifurcation today, especially with the 0.001%, they're investing mostly on proven teams and track records. They want to see someone who's done this before. They're not really looking at it quantitatively from the yield. They know that's going to come, but they want to see safety in numbers as it relates to other larger prominent families leading the investors, or someone who's done this so many times under his belt, his reputation's worth more than any capital he can put in. Maybe an example of that would be like Sam Zell, for example.
Mm-hmm. So, I mean, let's take a real look at that. So the average person, and I mean that respectfully, if you exclude their home, they may very well have nothing in illiquid.
No, I think the middle class is broke and desperate today. Really, if you look at their balance sheets, it's no, I mean, again, you live in you're in New York City. Where are you? Or
I'm in a little community called Weston, Connecticut, outside of Greenwich, home of Rolling Stone fans.
Okay, you don't. Okay, you don't live in America. Okay, you don't. And most of America, where I am in our tax haven of Las Vegas right now, is levered pretty well because they're able to get into these $1 million McMansions with a $50,000 down payment that they might have borrowed from someone. The cars they buy are leased. So it's made up money. It really is. It's pure credit because there's no way that their salaries are able to keep up with that, which is why you're starting to see the emergence of the entrepreneur class, especially as a result, maybe as a consequence of the pandemic, where people are really starting to say, hey, look, in order to survive, I'm going to have to do something a little different, as it relates to the middle class. And I'm just saying, like, there's a difference here, because when you are dealing with people who have operating companies that are throwing off tens of millions of dollars a month or hundreds of millions of dollars a year, they're looking at things much differently than the person who is trying to actually save money in a 401k and looking for the next, meme stock to follow. And it's an entirely different emotional state, to be frank, that a lot of people don't talk about.
So in terms of those that have resources and your experiences with, again, that top 1/1000th of 1%, what percentage or allocation percentage of their portfolio is effectively in illiquids? And I'm including even primary residence and a business. Is it 10%? Is it 50%? Is it 70%?
No, much more than that. Much more than that. Yeah. I mean, actually, if we have a common friend, okay? We have a common friend. His name is Alan Snyder, and he's in the book. And he said that, based on his research, Yale, just looking at the Yale endowment, not too shabby, very well performing. They have 92%. No, Yale has 86% of their endowment in alternatives, in privates. And Harvard, I think, has it at like 91%. So what do they know that you don't?
Okay, but they also don't have to deal with certain issues on taxation. So maybe a question I'll ask you, reposition.
Who cares?
Oh, I don't know. It's only taxes. But over the last 10 years, public equities have done, I would say, rather great. Do you just ignore that, or that's just a small sliver of the portfolio to the kind of people that you're dealing with?
I think it's a function of control, because if anything happens in the market, or say China were to do something today, we're in a globally interconnected economy. Look at what happened to Bitcoin when I think they made the mistake. I think Prime Minister Xi did a very bad job of doing that, because he telegraphed to the rest of the world that you can't trust him, or, he's able to do something like that. So that's your risk right there. What's your risk if you're involved in all these stocks that have gone up 10 years, for the past 10 years, but they're all semiconductors now in Taiwan? What does that do to your performance, right?
I mean, is that discounting the FANG +2, the Microsofts, the Googles, the Teslas?
Why have those gone up so stratospherically over the past 10 years?
Why?
Do you think low interest rates have anything to do with that?
Of course. And part of it, of course, the technology spurred by COVID. But these are globally dominant companies. Do you think they're just going to drop by 30, 40, 50%? I mean,
no, I don't know what's going to happen, but I do think that if there is a 25 basis point rise in interest rates, you'll probably see the Dow sell off at least 5 to 10 points.
So if I'm going to be,
and that's not going to happen. Wait, hold on. And that's not going to happen, say, in my life sciences venture portfolio, where there are lead families in there who are lead bioscience lead investors into that, where they have control and they know that there's cash-rich pharmaceutical companies that are looking to take over the technology. You see, so it's a control thing. It's how do you hedge it? Whereas the average investor is just looking long, for stocks. These families are looking more for control and protection and insulation, and they work differently, and that's why they're attracted more to the privates, based on my estimation.
Would you say that in your experience with families that have whatever over 50% in illiquids, which you're correct, for those at a high level, I may disagree with that percentage from my experiences, but yeah, there are going to be some. But here's an important question. Are they getting cash off those illiquids? How are they maintaining a liquidity and cash position?
They most of it is commercial real estate, to be honest with you, and fixed income alternatives that I was telling you about before. That's what they're doing right now to generate the income. Some families have gotten hurt, to be honest with you, because they're multifamily operators, and there's been certain legislation that has been passed that's hurt them. So some of them are licking their wounds.
Yeah, people aren't paying their rent.
Yeah, so it's an issue. But the ones who are looking into it, they're looking more to repeat what they've been doing, is just keeping it into well-operated, managed Class A assets that they can, that's really what it is. Because if they didn't have the liquidity, they wouldn't be investing in it in the first place, right? They have continual liquidity streams that are coming in, whereas most middle-class people don't.
I mean, let's go a little back and forth relative to, like you said, and I agree with you, VC happens to be venture capital, a common investment strategy for many that are, let's go with the verbiage, super rich. And look at the return profile over decades, it's pretty attractive. You could look at anything in 1 or 2 year periods and it'd be disappointing, but longer term, it's been attractive. But now I'm looking to be an LP, a limited partner. I'm not a decision maker. If I own a liquid portfolio, a Microsoft and Google, I could get in and out. I could do leverage. Not that I'm recommending that. I have more flexibility, don't I?
Yeah, you do, but that's just your personality. Some of these families don't have the personality for that stuff. Think about the real estate families in New York. Do they have any stocks? You and I know a handful of them. No, they don't. They're all real estate, right? Unfortunately. And they're all in the
same... I was going to say that.
yeah. But I mean, they're looking at it now, but going into stocks to them is something that they don't know about, because to them, it's just like another liquid product that they're going to have to pay some advisor a fee on. And there's also a lot of risk too, where you don't know what you're getting into. There's a lot of, products out there that are packaged that are liquid, but they're smart and they understand what's rising the tides right now. And that's that you're in a very low interest rate environment that's incredibly accommodative, and that was only made possible by the fact that you had 400 years of leverage poured on in 18 months during the pandemic. So they're looking at it not so much as what they're missing, they're thinking about is what's going to happen next.
And how about in terms of being an LP, whether it's private equity or venture capital? My experience more so with venture capital, even billion-dollar families are like, Angelo, I'm trying to get into the top 5 or 10 shops. We all know who they would be, Lightspeed, et cetera. I can't get in. Maybe I could get in through a fund of funds, but I have to go to other venture capitalists that maybe don't have a track record.
Yeah, you know what? I mean, that's a very good question, and I'll tell you this. I actually did a video series with a bunch of families, and we were talking about, one of the questions I asked them were, why would someone want to invest here in these deals, whatever, rather than being pitched Menlo Park? And really what it comes down to is the nouveau riche who are not established want to tell their friends that they're in a Menlo Park fund, even though those funds are too big right now. They're almost like monolithic utilities. So to me, when somebody says that, it means to me that they're not established and they haven't evolved yet, and they're probably not ready, because the ones who are really paying attention will join other LPs or societies where, first of all, they're aligned on a value system. But other than that, moving forward past of it, you're dealing with LPs who have more experience than you, making direct investments where you have control, not on a fund where you're going to be paying a lot of fees for someone to hold your assets for a continual period of time. So to me, behind the scenes, we snicker and say, oh, they're nouveau riche, wait until he finishes the Lamborghini stage and all that stuff. And, then maybe he'll be a little more mature at that point.
Let's jump into a couple of the specific asset classes. Many of them will skew to being more illiquid, so it could be up your alley, and we could go a little back and forth.
We can go back and forth, Angelo. It's fine.
We
I
love
don't
back and
fight.
forth.
Okay, okay.
I think
Tell me how
perhaps
it is.
I think perhaps the most common illiquid asset held by many, and probably the greatest creator of wealth to people to be millionaires, is going to be real estate. But like you did say earlier, there's various aspects: single, multi, commercial, warehousing, data storage. Talk a little bit about allocations of the super rich into real estate.
Yeah, I'll tell you, nothing residential.
And that includes single family other than their primary home, and no multifamily?
No multifamily. No, definitely not single family homes. No.
Okay, let me dive into that. And I think you're right, but let me dive into that. So has your opinion changed during COVID on multifamily homes with the risk of no pay culture? Is that the main reason?
Yeah, absolutely. I mean, we have a 166,000 square foot Class A facility that we partnered with a very prominent West Coast family, American family based in the West Coast.
Mm-hmm.
And the reason why I went to industrial is because I saw certain things in the market with multifamily, but it was becoming much more socialized. And during the pandemic, a lot of people lost everything. And a lot of them right now, I hear, the sob stories of bankruptcies and stuff. We're out ahead. We have 100% occupancy first quarter. We're at 99%. We're at 99% right now. And if you go to dandrewpartners.com, there's a video that shows the drone, which is how we communicate to our LP success of this. So the families are looking for things where they have no risk, right? So when you go to bed at night, you always want to make sure that your tenants are richer than you. And I think the mistake people make is that they think that tenants have to pay the rent. And we found out through COVID and politics, that's not the case anymore. So the tenants that we have over here in Las Vegas are subsets of Amazon, Milwaukee Tool, Carrier Air. These are companies that have been around for at least 100 years. These are steady Eddie. The pandemic, we underwrote that around $1 a square foot. But what the pandemic did is it changed my view of it, because all of a sudden it showed how the entire economy just transposed into industrial at a time where, we were kind of the weird guys going into it, but now we look like heroes because the rents have gone up because of COVID. And that really is part and parcel to trust, because investing is based on trust. And you have to trust, especially if you're using leverage, if your tenants are going to pay the rent, that you'll have some sort of right and remedy. And today, I think people have to realize, if they're looking at an investment, is my tenant richer than I or not? And how am I going to sleep at night knowing if this guy is going to have a job tomorrow or not? Because legal advice in anything residential today is free for the poor and stupid. And a lot of families, emerging families, who try to come in and become multifamily developers after getting some nice exits, I've seen fail in the 2007, 8, 9, because they didn't understand anything about operating risk, leverage, dealing with GCs. And they thought they could do it on their own, but there's skills that do not translate from one skill set to another.
So if anything, single and multifamily home is something, at least for now, to keep away from. What are some sectors in real estate that you look at as being attractive?
That's a very good question. We love industrial. We also love very targeted office in certain areas. We like Austin office. They were working on a project there. And then I think the crown jewel for us at the end of the year for a lot of the families is going to be what we call life sciences office and labs in Boston. And that's Class A, that's a statement asset. And a lot of the families gravitate towards that because it's something that their friends are not into. Think about it. If there is a lockdown, or just for the next 10 years, the economy is primarily going to be driven by healthcare and life sciences. And what better place to invest with a very well-funded industry in Boston? So these are the things, that the assets that these people like to go to, because they know if there's another lockdown, they're still going to be able to collect rent as they did during the lockdown here in Las Vegas. But also, should a crisis happen and say, again, you need Boston. Boston has always been the capital of intellectual, capacity and for the United States, besides New York. So there's not going to be any shortage of intellectual capital living there, working there, and we are happy to be a part of that.
I mean, you mentioned office, but you were tactical in terms of Austin, perhaps Miami. Those are markets where office space. I've been to Miami 10 times this year. It seems like every time I go there, the price keeps on going up.
Remember, Miami's been boom and bust. It has always been boom and bust. Right? Going back to the 1920s.
And you're in Vegas, so you would understand.
Yeah.
I think those are very tactical moves. And from a illiquidity perspective, looking longer term in terms of legacy. Now, we didn't even get into with real estate, depending on how you're getting into it as a direct owner, an LP, where you may have obviously no control as an LP, but there are some tremendous tax advantages of real estate too.
It is, but I mean, you have to think about it this way: is that if you really want to go in and be an owner-operator, you got to get your hands dirty. That's not something you're going to be able to outsource. You're going to have to get involved with it. You're going to have to deal with lenders. You're going to have to lift up your skirt. There's going to be a lot there that you're going to have to do to get involved with it. And remember that you're getting into a later stage of the market. So if you're entering as an owner-operator, chances are you're buying at the market right now. Whereas if you're partnering with smart families, they've already bought the land beforehand. They've been sitting on it. They're developing it now. There's a lot more. Market equity in a lot of these opportunities because they were purchased and assembled a long time ago at a very low basis. So when you're going into an LP, when you're going in as an LP, there's tax benefits and everything. But you have to think about it. What's my risk? So if I'm going to be an owner-operator and I'm going to be the Donald Trump of Parsippany, New Jersey, and buy multifamily, and know that you're going to be personally guaranteeing loans. And if anything goes wrong, you can't manage the manager. If anything happens and people don't have to pay rent in New Jersey, you are going to lose a significant amount of your net worth. And if you think about it, like him or hate him, Donald Trump guaranteed a lot of loans during the 1970s and 80s, and that was during the 1970s, and then during the 1980s. He got wiped out and, he was $1 billion in debt. Today, he just licenses his name. So it's a lot easier for people today, and I mentioned this in the book, to be an equity investor if you're a large family, to look over the shoulders of the bigger guys to see how they're doing it, rather than doing it yourself. Because at this point, it's just your check and you can dust yourself off if anything happens. Meanwhile, if we go into an environment where interest rates go up and you're starting a development now, or you're starting a development with someone who's never done this before in a shaky environment, who hasn't been through at least 2 credit cycles, then you're gonna be taking on a heck of a lot more risk and heartache than you probably should. Which is why I advise families to start out slow by just writing a ticket, because your heart is where your treasure is what they say in New York.
And you are correct. Being a real estate operator, I mean, that is you're in it. I mean, your hands get dirty. It's not going to be for everyone. There are times when it could go great, and depending on your liquidity, times where it may not be so great. And opportunity zones, 1031 exchanges, tax benefits, and leverage, those could all play to your benefit. I get it.
Shiny object. It's a shiny object
for you.
I know, but the 1031 is a shiny object to some people, where they feel forced to overpay.
Yes, you're correct. I have seen that happen. How about you happen to mention farmland. I was going to bring that up. Do you think that could be a strategic investment for the top 1/1000th of 1%?
It is, but you have to remember, you have to put together a sinking fund, because, unless you're, leasing it out or something, and it's on it waiting for the end of the world, right? That could come sooner than later, but it's something that it's not going to be an income producing asset for you. It's something that's going to require a lot of maintenance. And I think people need to understand that. It's never just the land and having it there. You got to maintain it, especially if you want the arability of it too. There's a lot of things that you need to do to maintain that land and the integrity of that land so that you can have a good yield.
But if it's more than just land, it legitimately is a working ranch land or farmland. You would think, in theory, it's bringing in income. It does have, here we go, with tax advantages again. But again, real estate, you're getting your hands dirty. Pardon the pun.
Well, now you're doing more with a ranch with horses and cows, right?
Literally.
So, and now you're shoveling things. So, I mean, sure, it's your identity. If that's what you want to be, and you want to be Angelo and put on a cowboy hat and move to Montana for tax advantages, fine. Just know that that's not an investment that's modular. That's not something you just clip a coupon from. That you being an owner operator with that ranch, with your F-150 on the front lawn and everything, and
And Sal, just so my audience knows, one, I do have a cowboy hat. I own 2 pairs of cowboy boots. I've been to Montana. I love it, but
Okay.
I'm more of a Wyoming guy.
Okay. All right. Sure. Yeah. Yeah. I get it. I get it. No, I understand that. But I mean,
And
it's an identity and people don't understand it.
well, I don't literally necessarily mean it from me or someone of resources doing it, although maybe I might add. I mean simply from an inflation hedge and as an investment. Now, again,
Mhm.
maybe rarefied air, billionaires, throw 10 million here, 40 million there,
Yeah.
and have it already be something that's kicking off income and giving you benefit.
Yeah.
Do
That's
you look
fine.
at for
Yeah.
them? Is that a good inflation hedge?
Yeah. I mean, it's not real estate, it's operating business, right?
It's both, I guess, but sure, you can make that
Okay.
point for part of it.
Yeah. I mean, every billionaire has a ranch that I know.
Yes, you beat me to the punch on my next
No,
comment.
that's really what it
It's
is.
a
And
trophy.
a sports team So, I mean, I'm not arguing against it, but, one puts money in the pocket, the other one is like, you know,
And actually,
but
since
yeah,
you
yeah.
since you did bring it up twice, and I guess you could say
Okay.
it's a sexy topic,
Hmm.
talk a little bit about the people that at the level that we're talking about, their interest investing as I guess, usually a limited partner in a sports team, and how
Hmm.
attractive has that been from a legacy asset?
I mean, it's probably the penultimate asset class you can probably get into right now, besides like owning your own spaceship, because behind your back, all your friends say, I know Angelo, the owner of the New York Jets, and people like that. Their status is enhanced by their association with you. So I think it's the ultimate statement asset class. But what makes it different than most other things is that in real estate, people will take a check from just about anyone, right? And it's usually, nobody knows who the LPs are. But here, there is a mean girls group and they have to put you through a qualification process. And sometimes that's not necessarily polite. So not everybody is allowed to become an LP owner, because a lot of these brands, and using the NFL, perhaps the European soccer clubs, they don't want bad apples in their to tarnish their brands. Because if you think about it, the NFL is probably the most well-protected brand out there, and they don't want to fragment it and bring in other people who offend the other owners and sort of like cause problems. So you'll never see like Joe Sixpack, I think, being an owner of the Giants. I think if anything would happen, this would happen where it would go institutional, and you'd have more of the institutions like the Bains and the private equity firms going into it. I don't see that happening yet, but if the valuations keep going up, that's fine. But people do it because they want to be seen and heard. They're usually first gens. They want to be seen and heard. They have businesses and they want to enhance other businesses. Some of them, for example, I talk about in my book, were the founding families of sports owners were the original real estate families. Or let me say that again, the original sports ownership families were the real estate families. And they're the ones who had the foresight and the discretionary income to be able to go in and buy a lot of the distribution for how these sports were put together. And that's just grown. And today it's just become much more attractive because of the fact, principally, you have gaming that's been introduced to it. So when you see people who might be recklessly maybe overpaying for something, they're overpaying for something probably because they're seeing it's part of the pro forma, the gaming revenue that's coming now. And living in Las Vegas, I can tell you, opening the Allegiant Stadium, I was actually very privileged to be invited by a friend who lives here, a prominent Las Vegas family, on Labor Day to walk around Allegiant Stadium, which is the Raiders Stadium. And it is world class. And I can tell you,
It's beautiful.
there is gaming, gambling, flashing all over you, right?
Yeah,
And
they
I
monetize
get
it very well.
Yeah. But think about it, like and the brand installation is great. The value only goes up. So when you're talking about these families talking about liquidity, to them it's like I have $250 million into a deal, into an ownership, not us, but just a person in the book that's gone up 5 times. Where else am I going to get that appreciation and protection? And that's something that, besides real estate and fine art, it's very difficult to find. But remember, that is
something called cryptocurrency, but we'll get to that.
I mean, okay, right. We can get into. I mean, I know you're not going to let me out alive without a good crypto dialogue. But but again, the people I know and the older, more established families, where you are, they're not really going into the fragmented stuff. They're looking to continue that legacy by being part of a sports owner, or being part of a owner of an office building in a tier 1 city.
I happen to be a sports fan, a Giants fan in football, by the way. Uh, Finally, they got a win. But you look at it and say, my God, that person spent XYZ on the sports team. Look at Ballmer with the Clippers a couple of years ago. And no matter what you think, it seems like a couple of years later, it's worth way more money. It's amazing the resiliency and appreciation. It's too bad we all can't do it, even as an LP. Does this make up a tiny sliver of many of your client portfolio?
The sports owners have a tremendous amount of their portfolio in sports, the established ones. If you look at like Ann Walton and Stan, he did it perfectly because he started out by being an LP small, getting a lot of experience as an operator, and now he's a GP. And he's I think the textbook of how a good allocator should be. Other people just want to go in and be heard and seen and be able to tell people that that they own a part of a team. Then you have the others who are like charitable trusts, and they just exist to give away money, so they don't really care. But that, when you look at the sports teams, it's usually as a function of a much more significant part of their overall wealth on a distributive scale, like a pie chart, just on a current market valuation today than other assets that they have in there.
We mentioned an asset class earlier that's illiquid, and that would be venture capital. My experience is probably most families at the super rich level, we all define that differently. I actually am asked that question. In today's world, I actually think being quote unquote super rich is probably about 750 million. I know it's a crazy number, but I have my reasons for it. You look at what's happening. Let me ask you a bigger picture macro question relative to that. I had on Michael Saylor. He's a very prominent figure a couple of months ago, and I completely agreed with him. He basically said, for people at that level that are buying sports teams, that are buying more stock, that are buying crypto, that are buying art, their inflation, it's not 3 to 4%. It probably is 15 to 20 to 25%. For them to keep pace, their true inflation for them, do you agree, is much higher than what the government publishes?
Oh, sure. When I was working on Wall Street, they used to call it the Big Mac versus the chicken tenders. It was, the CPI basket is so dynamic. It was, they just pull out everything that just increases. So if you look at the CPI, for crying out loud, it hasn't changed in 60 years.
Yeah, I don't believe it. It's individual for everyone, and the people at the level that we're talking about that want to buy more of those kind of assets, I completely agree. It's into the double digits, probably in today's world, 15 to 25%.
Remember, those people have access to that because they have strong networks, right? Not everyone's going to walk on the street and say, hey, do you want to buy a part of the Raiders? It's not going to happen that way. It's a very exclusive asset class.
And in terms back to VC, would you say that usually makes up 5 to 10% of the portfolios that you see, less or more?
It depends. I think it's a function of the identity of the investor. And in my book, I mentioned 5 different avatars. And if you're looking at the one who is more aggressive, maybe the first generation, you're going to start to see a lot more venture there. They're taking a lot more risk. We've seen that later in subsequent generations, but we call them the mogul. Whereas if you have someone who is more of a real estate family, I call them providers, they're not going to have more than like 10% into it. They like it, they love it, but they still have in their DNA that they're not ready to like open up a sidearm yet to just dedicate the venture, because they like sneaking over our shoulder and participating and seeing our exits and our success. So it's a function of the personality. And then you have others who are just going to be very identity driven, who are going to go either, these are hedge fund managers that go either in all stock, all crypto, all, something what they know very, very well, where they're able to, where they have, information asymmetry as their bias. But it comes down to, it's not as general as you think it is. It's just a function of the identity. A lot of the families I talk to, especially west of the Mississippi, they know dirt, right? And if I show them anything that's not real estate, it's like I'm bringing someone allergic to shellfish to a clam bar. It just doesn't fit, and I lose credibility. So you really have to know what these guys are looking for, and for us, it's the function of their DNA and what makes them comfortable. But the fact that we put together these types of club investments with other families, they feel very, very confident investing into other things with people who are other prominent families, people who have had a lot of exits and really exploring the space, to add another layer to their legacy.
And I guess a relative of venture capital, but pre-venture capital, is going to be startup or angel investing.
Oh, yeah. Not a lot of families I know deal with angel investing because the least sophisticated people do it, and they wound up getting quashed or crammed out.
When they do one-off, or when they invest in a quality fund?
When they do one-off.
One-offs can be very difficult.
Yeah, that is like Russian roulette, right? You just don't know, and you know, that's for people who don't know what they're doing, I think. And we've never, you know, there's a difference between early stage investing, speed investing. But when you, again, going back to what I was talking about before, the whole reason why this business works is because for the 0.001%, you can actually control the terms and the basis you're getting into these opportunities at.
Yes, I would agree. One-off investments into earlier stage companies takes a lot of time and effort, and the pros have a hard time being right on those that will quote unquote be a unicorn or pay off big. What advantage do you think that you're going to have? You may get lucky, but I do think there should be some exposure, in my opinion, to that asset class and what I see. But that usually is as an LP.
I'll give you my 3 rules on this, really, and I think it's the same for anything in private. You can modulate it for real estate. I'm a real estate guy. I modulated it for venture and the venture deals. But really what you want to look at, and when you're going into these deals, is who are the co-investors in these deals, right? If they're small, fragmented people from a broker dealer you don't know, that's money that operator doesn't really care about. That's, you know, that's probably very, very less sophisticated money. But if you have larger name brand families, you know, that have strong research arms, and they do a lot of diligence because they're protecting their own brand and legacy, and it's not just the money to them, those are the guys who you want to find. To me, the capitalization table, or the investors or the LPs in these deals, are the soul of the asset. And it reveals to me the sophistication of the CEO and lets me know, which brings me to number 2, has he done this before or not? How many times has he done this? We hear the term serial entrepreneur all the time, but I like serial entrepreneurs who have had a lot of exits, not who have started a lot of half-built bridges, so to speak, that have never completed. And then the third one is you want to find out, you know, you want to verify that, but you also want to see too, you know, what their contribution is to it, and check out their record to find out if this is something that's a good fit for what they're doing right now. Who are they working with? What's the team that they're working with? Have they ever worked before together? These are simple things, but culture affects a lot, especially in families, but especially in companies when you're investing into these things. And I like to, you know, the more exits that a operator or entrepreneur has under their belt, the better it is. But again, in order to get to those points where you can have those conversations, that requires trust that you'll write the check. And number 2, you have to have some sort of a background, or people need to know you, or you need to be part of a society so that people can invite you into it. Otherwise, if you don't know who we are, especially in this environment that's politically charged, why would we want to work with you? Why would you want to bring in something to shake up the culture of this great company if you're not going to bring in anything other than, you know, just financial capital, right?
In my experience with the, again, quote unquote, the super rich, the most common illiquid asset class for them, and again, it varies, but I mean, whenever you use averages, it could always be skewed, but it probably is private equity. So they're wealthy families investing in, quote unquote, usually as an LP in a fund that's established, that's investing, quote unquote, in established companies. What are you seeing on PE? Allocations going up or down? How is it playing out in distressed? Give us the full picture.
Right now, I've seen a lot of GP co-invest in private equity, which looks very, very compelling and very interesting. A lot of the LP capital today is chasing after the same things, the institutional capital, that is. The families zig where the institutions zag because the institutions have gotten too big right now to really make a difference. So the families, and you're starting to see this trend, is that mice go where elephants can't, and they're going into smaller companies that they have core competencies and experience into, investing into those and helping those is more of like a strategic type of thing where you're allocating reputational capital to, you know, put the 2 canneries together, whatever it is, and creating something where they can have a lot more control. That's what a lot of the families are doing that I see in private equity. There's a lot of private equity funds out there. There's a lot of people raising money for private equity. I have been more focused on the venture capital space, to be honest with you, over the past 2 years. They do run side and side. They both have the same similar conventions, but the older established operating families, when they make investments, it's usually like a strategic direct investment into a company combined with many other intellectual reputational resources to really blow that up for a quick exit. That's what they're doing in private and private equity. In venture, they're just allocating to the smartest guys who have done this before, who are out of their, who are out of their league, but have strong, competent families as lead, lead LPs or lead investors on this who have done due diligence.
I think, Sal, that's, good advice. And yeah, that's probably pretty much along the lines for the most part of what I see. A little bit of a quick time out for a second and a heads up to those watching or viewing in. This is for educational and entertainment purposes. We're saying it, in early October of 2021. You may listen to this a day from now, a year from now, 10 years from now, and our opinions could be completely different. In my case, probably the next day. So this is not meant to be investment advice at all. You need to do your own diligence, make your own decisions. You have your own risk tolerance and liquidity needs. And when you invest, you could lose everything. This is simply for quasi-educational, more so entertainment purposes. So just a heads up on that. Let's go into a subject that you're very fluid in and one I'm very intrigued by and think is probably underrated as well. And that would be art. Talk a little bit about that.
Yeah, art has been a statement asset for years. People like to talk about art like fine wine, about the provenance and everything, but really it's a painting they own that you don't, right? And it's a great way for them to actually, store wealth, right? Because think about it.
Yes.
I was at a conference. This is interesting. You like this. So I was invited to an allocators conference last week by someone we know. And a lot of the people there were families west of the Mississippi. And they had the same concern and everything, but what they came to the realization was that art was something that was not only indexed to inflation, not only does it have provenance, but it's extremely liquid too. And that's what a lot of people really have failed to understand. And it's been like that since the bubonic plague. I mean, even during the plague that we had here, there was I think in London, a museum got ripped off. And there is an article on that. I just can't remember where I read it. So art is something that is seen as high status, and we're in a very conspicuous society today. What I am seeing right now, and through other things, is people are trying to leverage the best assets they have as collateral for funds. And there's a lot of people who are not as liquid as you think they are. And there's opportunities, especially going back to sports, who say, hey, I need to liquidate something, but I don't want the whole world to know, sort of like Ron Perlman, right? I mean, he sells art, everybody thinks he's going out of business. So there's a lot of clandestine discretion is the word we use, intra-family, where there's a lot of lending that goes on. Let's think about it. If you had $10 million sitting in the bank today, and this is a real question that I've had with someone, does the FDIC insure that? Or if you were to have say like a Picasso that was worth $20 million, that was insured for 40 because of redundant insurance, and that burned down, where are you going to get your money back from? Private insurance. So people today are structuring, a lot of these families are pioneering a lot of conventions that are usually, and this has been the way it has been since the beginning of time, since the Venetian merchants. And really what we're talking about here is they come up with products to be able to protect themselves from any sort of catastrophes that can happen in the future by hedging it into other things that are not correlated to any systemic operational or political risk. Did I do a good job of explaining that?
Yeah, I mean, I see definitely tremendous interest in art as both a passion and strategically, arguably as a store of value, and simply something historically over longer periods of time that has been attractive. But it's not just investing in art or theoretically as an LP in art funds that are popping up. There also is lending strategies that you're starting to see as maybe a replacement for fixed income.
It is, because I think, we've had dynastically low yields for 20 years. I know it went up a little bit maybe, but there's issues there. And then real estate, a lot of people found out that real estate wasn't as anchor as we thought it was. We found out that oil could go less than zero. So when you look at the short term here, it's very innovative how a lot of these families have put together, because the one person I'm talking about was one of the pioneers who started the Discover card. And this is someone you and I know very well. But he's been able to put together a structured product that allows not only for his family, but for other families that he's been managing money for over 40 years to be able to be insulated from other things that are happening in the marketplace. Because rich people have problems too, and real estate sometimes isn't the answer, especially if you don't have a deep enough network to be able to become an LP into a nice deal. Then you start running into like, well, I want to join the name brand Menlo Park Fund. Fine, you're not going to get anything out of it. You're not, maybe, I don't know what the performance looks like. I know what the fees look like, but I don't know what the performance looks like. So this is why a lot of you're starting to see a lot of innovation and pioneering happen in finance, especially at the upper levels with families, because they're more scared than you because they have more money than you.
And in terms of, you mentioned it before, and I think it's an underrated, quote unquote, illiquid asset for strategic families of great wealth to get into, and that would potentially be GP, general partner interest in various funds. There's a reason why there's so many billionaires that are hedge fund and private equity and venture capital managers. I guess the 2 and 20 business model is a good model.
Well, you know, it's interesting.
When you raise billions of dollars, it's pretty damn good.
It is. We love GP. We love GP co-invest. We are not LPs, and with the exception of certain real estate deals and things. We love the GP co-invest, and for that reason, that requires you have to have trust with the operator. You have to have trust with the entrepreneur in order to do that. And in order for that to happen, you need to be able to show that you are a grown-up men and women and not just some boy or girl off the street. What I mean by that is that you need to be able to bring strategic capital, not just capital like you writing a check, but what else are you going to do? I'd rather have someone that writes a check for $2 or $5 million who has some sort of corollary interest into the fund or the initiative of the fund than say Tommy Boy who is putting money into it, but then he might flake out a year from now and not understand because his personality hasn't evolved enough yet to the point where he's still chasing dreams.
And one, I want to double check on time. We're 5 minutes
Sure.
before the top of the hour. Do you have 15 minutes?
I have about 15. Yeah, absolutely.
Okay,
bring it on.
Let's take it a little bit to the home stretch.
Okay.
I wouldn't necessarily call it illiquid unless you're maybe a direct investor, but there's various ways to do it with liquidity. What do you think about certain commodities? Let's say gold and oil.
I think gold is underpriced right now. Oil, I don't know much about, but gold I do have experience with. The only thing I tell you about oil is that it did go negative at one point, and that is if you're looking at it that way, there's always going to be a risk there that people really never thought would ever exist before. But
and that was about a year and a half ago, but it's completely in the opposite direction now. It's going up, 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 and up. It's scary.
Yeah, it's like
unless you're an investor in it.
Yeah, it's like anything else liquid, right? It's like anything else liquid, right? It's just all parabolic. But gold, I think, is a little undervalued right now, and I think that there is a lot. I think the reason why it's undervalued is because I think, to your point, crypto might have been I think it's been a good shock absorber for inflation. And I think during the pandemic, if there wasn't crypto, I think you would have seen a higher stock index. You would have also seen probably higher gold prices too.
Interesting perspective. And you beat me to the next punch. Of course, no one in investments could get away from me not asking, and I'm fine with different opinions, by the way,
Sure.
but broadly about crypto assets. And I'm an older guy. I heard about it in 2011 and like, what? I put a little bit of money in 2017, but I didn't really get it. And during COVID, I had a chance, as my audience knows, hundreds of hours, become a direct investor and really dive into the community. But why don't I be quiet, get your feedback, and we'll talk a little bit.
I think we participate. So I have a story with crypto. The only way we participate in crypto is that these tokens are given to us in exchange for an equity investment, usually. Mm-hmm. So to say that but I am not actively going out and buying crypto going long. It's too speculative right now. It's controlled by 80% retail investors, and there's really no guide rails on it right now as it relates to it being a store of wealth. What do I mean by that? Well, you still have 75 trillion going around the world every day in cash and US dollars. It's not going to be really close, I think, to crypto yet decentralizing that, but there's a lot of faith and confidence still in the United States to do that and to carry through in the reserve currency. The other thing about it too with crypto is that you can't control it. You can't control it. What China did when they started banning crypto was that they put something out to the world to tell people that anyone can do anything to hurt you. And I think that woke a lot of people up to the crypto circumstances, that this is not a long-term investment. This is meant to be something more of a speculation. And I think that's really what it is at this point. I think for the middle class and for the retail investors, it's always going to be a speculative experiment until the institutions come in, straighten it out, see how everybody has worked out. Then you'll see maybe not so many head fakes with like Elon Musk saying he's buying crypto and then he doesn't, or Walmart saying they're going to buy, start taking crypto and they don't. All these false flags are doing is just making people, rich off of speculating off of it, not holding it long term. And if you think about people today and the average holding time or duration that they hold an asset, even if it's their personal residence, it's less than 10 years. And I don't really know how anyone's going to be really sold into buying something that hasn't been around for 10 years to be long-term 10 years longer, especially when you don't know what could happen on the other side of the world tomorrow with all sorts of non-kinetic terrorism, such as Facebook going down, Bitcoin going down. You just don't know, right? I don't think we'll have a hot war, but I think you're going to start to see a non-kinetic war, with China. Just as it relates to a lot of this stuff that's been going on. So that makes a lot of the people very, very uneasy about it.
I think my opinion on Sal's comments is I actually think they're pretty well thought out. What I like to hear is someone who actually thought about it, did some research, and then formed a thesis that may be very well different than mine, but it's not a knee-jerk reaction of, I don't get it, therefore it's not good. So one, I respect the fact that you gave it some thought. And I think some of the things that you bring up are very fair. I actually very much disagree on the China one, but broadly with regulation, I think that could be a challenge, a possible government involvement in taxation. And you bring up that you doubt whether it's a store of value. I'm mostly on board with you with that. It's very volatile, but that doesn't necessarily mean it's not a store of value or won't be in the future. Let me ask you a bigger picture question relative to crypto. And I think you hinted at the answer. And that would be, what would cause you to change your mind? Would it be much greater institutional involvement?
Yeah, I think it's got to be much wider institutional involvement before people get into it. There's a lot of people who just don't you know why? Because crypto, unless you read books like you and I do, it's hard for people to understand. And it's easy.
And if you read a book on crypto, it's old like 1 minute later. It is.
Yeah.
The industry is like that.
It is, and it is the most rapid form of technology that has ever been brought to the human race. Think about it, right? I mean, the computer, the Commodore 64, that was, 64. Today, we're talking about things moving in real time faster than you can keep up with it. And the human brain just can't keep up with all of that, going on at one point. So it's really changed, if you think about it, the wiring of most investors today to be much more short-term oriented than long-term oriented.
I think you bring up very good points, and I can't deny that. And there's a level of, investment game theory and the emotions of the market that in stock markets and of course in crypto absolutely are legit and do play into it. Of course, I'm going to say that over the last 10 years, Bitcoin is dominantly the #1 performing, let's call it asset. And maybe it's hard to do the math on it, but maybe the best of all time. Now, do I think it will do this multiple moving forward? Well, you didn't get into it at 1 or 2 or 3 cents or even a couple of dollars. So no, I think that massive run that, taking your whatever, a little bit of money and turning it into, oh my God, I can't believe it. I can't say
they never said it was a little bit of money. The people who went into it, they told you it was a little bit of money. And then when it started its meteoric rise and then crashed, I think in 2015, all those people disappeared. And now they've all come back again because they've all converged.
There are some people, not just the cyberpunks, that did stay with it. And sometimes, like me in 2017, I just kind of forgot about it. I didn't give it a lot of attention. And then I put more effort and time into it. What I would recommend to people, and I know this is not easy to wrap our arms around and it's changing so rapidly. Take the time, do the diligence, and form a thesis. Now, you could argue, like Raoul Pal and other great macro thinkers, form enough of a thesis, put in 1 or 2%, look to be diversified. If it goes to nothing, it's not going to crush you. If it goes up for the asymmetrical return, it may be worth it. What I will say about some of the other aspects of what you said is, of course, I'm looking at institutional adoption, more so in Bitcoin and Ethereum. Mass Mutual came out publicly, I believe, last November. There's been others, ironically, in the ultra.
El Salvador came out. How did that go?
Oh, who is that? I'm sorry.
El Salvador also rolled out. How did that go?
And that did not have the level of a bump up that many people thought it would have. But yes, we're all following that.
It's working. It's getting there. It's working. It's not going to happen overnight.
It's getting there. Here's what I will say. Just 3 hours ago, I interviewed Robbie Bach. He headed up the Xbox team. He was a president at Microsoft. One of my last questions before he exited, I think I asked him some pretty interesting questions. I didn't want to say the man himself, but I said, you've been around some of the world's wealthiest people. You probably don't know, but do you think they own Bitcoin and Ethereum? And he said, I do not know for sure, but from my putting 2 and 2 together with the billionaires that I know, they all own something. My experience with hundreds of members and thousands of families, even those that are older and claim otherwise, many of them do own. The Goldman Sachs study, one of your former employees, came out 2 weeks ago, and I think it was a little high. It said 60% of ultra high net worth investors. My research is closer to 30 or 40%, but I think
they also sell stuff too.
We are trending there towards it being quote unquote greater institutional adoption.
It'll happen. In the next 4 years will be very interesting to see what happens.
Now, if you feel that way about Bitcoin and cryptocurrencies, and you gave an articulate reason why, and how, what I liked about you too, is you're keeping your mind open to how it may evolve in the future, where you may have a change of thesis and opinion.
Yeah, oh, sure.
When you're looking at the big picture, mainly arguably through VC that invest in this ecosystem, do you look at something like the metaverse, NFTs, decentralized finance, or that's just not on your radar at the moment?
It's interesting. I was at an allocator conference and they sent me this whole continuum, like a rainbow, like the different types. And we haven't gone that deep into it yet. We have found some people that we have worked with on one project. It wouldn't really, I think, fit this. We worked with we co-invested with a prominent Japanese family into Sing Life, which was, sort of like a consumer finance product that's done really, really well so far. But I think going forward, you're going to start to see a lot of things move into, I personally think decentralized finance and things moving into that, which is why I'm not so bullish on Bitcoin right now going long. I love the convention and everything, but I think going forward, you're going to start to see a lot more changes as it relates to the conventions, technology, trust, security, and more of a sophisticated market getting into it, because I don't know, it's probably less. I saw 70 to 80% mostly retail mom and pop guys, all of crypto. And once that starts to come along and turn the other way, that's when you start to see a little more regulation. Maybe the government's going to try to do something for taxation. But until all that frontier gets worked out, then you're going to start to see more legitimacy given to the asset class, where you'll start to see other things change. We already saw it with Bitcoin. There's a bill in that changed for like 32 million in Bitcoin. Great. I mean, that's fine. Is that going to be the norm going forward? Probably not for the next, couple of years, but I could see that maybe going forward, where you have international buyers who want to own United States assets, and there's going to have to be changes in convention for accepting non-cash tender.
And Sal, in terms, as we take it to the home stretch, what would be some closing comments of things you learned in the research on your book and people you spoke to, and reflecting on your own thoughts that you would recommend, whether it's someone striving to be that top quote unquote 0.001, or maybe someone there? What are some maybe broad advice you would give them?
I would say the one thing I learned a long time ago was to, and believe it or not, be of service to people. Bury your ego by being of service to people, and you'll start to see that you will start to attract higher quality people who are not looking for something from you, but you can always use that to your own advantage. but I would say always be of service to work with people, because today people are, regardless of wealth, they are very confused, they're anxious, and they're looking for that. They're desperate for dopamine. They're desperate for people to reach out to them. Interactivity, I think, is the new currency, which is why I wrote the book, which is why I'm more active on social media now, posting stories about my trips and things. People want to see that. And that's really what people are longing for. It's why Netflix has been so popular, is that people are missing that dopamine, that oxytocin that they're not getting, and the pandemic has not given it to them. So you're doing a good job here through your Zoom. I can tell you that, Angelo.
Well, thank you. It's a lot of fun. Great to talk with you. There's one question that maybe I will highlight from a participant, and
Sure.
it was on my list, but I just skipped over it. Speaking of ventures, quote unquote, from her perspective, your thoughts on pre-IPO shares and investing in those. And I would think of a Starlink, a SpaceX. What do you think about that for people in this stratosphere?
The joke in my industry is that that's speculation for poor people. And what it is that you might be able to buy that and buy those shares. However, by the time you put the fees together and the holding period and the lockup period, you have no control over that. So it's still like the odds are similar to like a blackjack deck, right? If you think about it. So the way we invest is to go way before that, where we have discretion and control, right? And we can understand how long we're going to be locked up for and when we're going to get out and things like that. Whereas the people who are buying the pre-IPO shares are mostly retail investors who are speculating. They think they might, and then sometimes they do, it depends. But remember, when you're getting into these shares, for the most part, based on my experience and seeing and how these things work, you're obligated to a lockup. You would be with any other IPO, but you don't know where you are in the totem pole. And just because there's a lockup in 6 months doesn't necessarily mean you're going to get the shares in 6 months. Does that make sense?
Yeah, good point. Again, it's been great to have Sal Buscemi, that's spelled Buscemi, CEO and founder of Dandrew Partners and author of the book. We recommend you go and get it, Investing Legacy, How the Top 0.001% Invest. Sal, for those that are qualified purchasers, higher level investors from that perspective that may want to learn more about Dandrew Partners, could they go to the website? Is there
go to the website. Go to the website. We talk about a lot of the things that we do there. It's very direct. And it talks about, and there's something there that I would love for everyone to download. You can buy the book, of course, but there's a special report there that they want to watch. And the families like this because it sort of becomes a drinking game. And I put together a report before I sold the book, which made the book what it is today. That was 10 mistakes every family makes that have destroyed their legacy. Okay?
Oh, and, what a great title. I got to steal that one.
And so people download it, and then I'll get an email at like 4 a.m, and it'll say something like, I know 4 families that blew up exactly like that, next to number 8 or something. And
I'm going to have to download this. This is great.
You can. It's great. So you want to go to dandrewpartners.com. You can also go to salvatorebuscemi.com too. But if you want just that report, you'll go to investinglegacy.com/gift, and you'll be able to get that for you.
And there was one question. Let's give it a 30-second answer so you can move on. There's been a saying, you get rich by being concentrated and you stay rich being diversified. Do you always believe in that philosophy?
Say that again. I'm sorry. I had to switch my earpiece because we ran out of juice on the other one. We talked so long.
There is a saying that you get rich by being very concentrated, but you stay rich generationally by being highly diversified. Do you broadly agree with that?
I strongly agree with that. I've seen that many times happen. And if you think about it, if you're too fragmented, if you're too siloed into something, say you're a multifamily family in New York or Jersey or, forbid, anywhere else that, you have these rent these rent moratoriums, you're destroyed. Like a lot of them are destroyed. And so now they're looking at their VC investments, hoping to pick up the slack, right? So being very, very siloed like that is, I think, a recipe for disaster, because you want to be much more spread out and much more sophisticated with how you're looking at allocating into, especially real estate or, industry specific venture.
Very good point. Sal, I very much look forward to the next time.
Thank you
In
so
wrapping
much.
up,
Same here.
thank you so much, Sal. In wrapping up, I'm Angelo Robles, founder at Family Office Association and host of the Angelo Robles podcast. You could find me on all the social media platforms. Probably my main one is YouTube. It's Family Office. And you could always email me. Our core company is familyofficeassociation.com. And I'm Angelo at familyofficeassociation.com. I look forward to the next time. Sal, thank you so much for your time.
Thank you very much for having me, sir. Take
My
care.
pleasure.
Pleasure. Take care.
Thank you.